Who is Cube Corp? I've had the privilege of being with the company over 3 years now, established about 6 years ago by 3 people. The company is now over 106 strong. It's a fantastic growth through a period where a lot of the economy struggled to even keep their daily jobs, okay? So what are we? Are we just a real estate firm? No, we do all things to deal with property. So we have project sales, we have existing property sales, property management, we've got our finance team who can do home loans, commercial loans, figure out, how to get money from someone. Immigration as well, property development, and just this year we've started construction. Very soon we'll even have a strata team. So you can see that we're here and we're here for the long run. We're not just here to flog properties, we're here to help our clients grow their portfolios, improve their lifestyles. This is our mission. Nowhere there does it say to sell, and that's not what we're doing tonight. But if you want to buy, I'm more than happy to sell to you. The essence of Cube Corp is to assist and educate our clients. We do this through experience and expertise, not just in-house, but through a wide network of individuals and mass companies throughout Australia and globally. So, without further ado, I'd like to welcome a good friend, mentor, and tax expert, Mr. Salman Khan.
Pardon me for half a sec. All right. Is this thing on?
Yes.
Okay, good. All right, first of all, I'd like to thank Mark and Don and the team for putting this together. It's a really, really nice venue compared to the last place you put me. So everyone, just a quick one from Mark. He was stressing out. This is the clicker. So today's presentation is on protecting what's yours. Now, everyone here thought they were coming here for a tax talk, but let's face it, today's front page was how the ATO is going to crack down on $150 claims on laundry. $150 claim on laundry will equate to about $50 after tax. So we're not all here to save $50 over the next year. We're talking about big dollars. So the whole essence of it is, rather than just focus on the tax, which is a very small part of your savings, let's see how we can build your income and at the same time reduce your taxes. Secondly, thank you very much for listening to me today. I understand it's a very cold evening. You could have all been at home in front of the fire stroking the cat. Instead, you're here speaking to an accountant. You're either very brave or very, very, very bored. So let's set the mood. I think Mark made a great start at this. There's a lot of stigma around property investment. I think the more liberal side of the media likes to think of landowners and property owners as bad people who squeeze renters, and they always say happiness is not bought by money. You don't need money to be happy. So you're prodded, and you don't want to think about it. And what I'd like to do before we start is we get in the right mindset that money is a good thing. Money, it might not buy you happiness, but it can buy you options. And I'd rather cry in a Ferrari than in a Hyundai. So without any further ado, just repeat after me. Money is a good thing. I'd like more money. I'm a Queensland supporter. I'm just checking. There's always one. There's always one. Okay. So who am I? I think they gave me a little bit of an introduction at the start. My name's Salman. I'm a principal at Tax Advisory. We are not primarily tax accountants. We are reconstruction and valuation accountants. So tax is a very broad thing. My background is in insolvency, and there is a button on this thing. Yep. So my background is in insolvency. I've got a background in commercial law as well. And we move things around so people are in a better position. And that's what I'm going to show you later in the thing. I'm also a consultant to the UNSW School of Business Law and Taxation, where we work with the Pro Bono Clinic and help people who are less fortunate, while at the same time training their next branch of tax agents and tax consultants. So this session, just to summarize, we're not going to talk about anything too technical. I'm not going to be all stiff-lipped here. We're just going to try and make more money and help you keep the money that you have and the assets that you've worked so hard to put together. I was at the gym last year. I know, it is hard to believe. But a guy comes up to me, he goes, "Oh, you deal with this kind of stuff, this money stuff. I want to buy a property that returns me 12% in guaranteed rental return It increases by 10% in value per year. I gave him some very good advice to that one. I said, me too. The truth is, it's not possible. It might be possible for a small amount of time, but guaranteed and consistent returns, it's not going to happen. You need to make choices. At the end of the day, it's not a simple thing of putting money in the bank and watching it grow at an incredible rate. You need to make educated choices, and if it was easy, everyone would do it. Can we agree with that? That there's a reason why you're all here. You're making a sacrifice, so you can learn more about this. While I'm here, when you evaluate a property, when you evaluate investment structure, you typically look for certain variables, look for KPIs. Can anyone give me an example of something that they'd use to evaluate a rental property? That's an open question. Anyone can answer. Don't all answer at once. Would you look at... Sorry? Close to transport. I mean, I'm talking more in the monetary sense when you're evaluating an investment. Capitalisation. Yes, there's one. Mate. Oh. Yeah, wicket keeper. You going to share that with your wife? I just earned you some points there. Yep. Try and catch the next one. All right. So the first one is the capitalisation, or the increase in capital value that you'll see year on year. That's been amazing in Sydney for the last 11 years.
And the for that is the higher the rate, the greater risk and the value of the property later.
Excellent for the wicket keeper in the corner. Yes. So the greater the risk, the greater the return. Generally, that's what we're speaking about. The other thing people typically look at is the rental yield. We've heard of this. Oh, it's got 5% rental yield, 6% rental yield. So there's typically a trade-off, as you have very, very generously said, that typically where you've got a high capitalisation or a very high increase in capital gains, you typically have a smaller rent. And where you've got a lot of rent, you typically have very small capital growth. People centre around those two things, but the fact is that's not custom to your circumstances. For example, how much tax you're paying, how many properties you have, whether you can move some of that money to your wife, whether you've got it in a superannuation fund, a family trust. That's just numbers for this particular property. It doesn't give you what you need. What we typically look at is cash flow analysis. And a cash flow analysis sounds pretty trendy, but what it is we just look at the individual property, your circumstances, we take into account taxes, depreciation, everything, and all we do is see how much money it starts off with and how much money ends up in your pocket at the end of the day. And then from there you build. How can I change it to make more money in my pocket at the end of the day? If you just look at rental yield and capital gains, well, you can't make the value of the property go up on its own. And you can't just increase the rent because no one's going to come and rent it from you. Those ones are sort of out of your reach. So cash flow analysis, we typically use it in businesses. We're not the normal accountant. We don't have people coming off the street. We normally deal with larger businesses and high net worth individuals. So what we try to do is bring the valuation skills and the modelling to people such as yourselves. So like I said, it reflects what you actually pay and receive. We use it for common business analysis, where you evaluate whether or not to buy a business. And it's much more individual. So it takes into account your tax rates and your circumstances in life. So here's a typical question. Not actually posed to me. This is hypothetical because I've made it swap around. You have property A and property B. Rental yield 7%, capital growth 2.5%, and the opposite on the other. Just on the face of it, can anyone tell me which one's the better investment? Wicket keeper. Property A. Why?
There's less risk factor there. You've got,
but how do you know where the property is?
Property B.
Risk factor. Is that your final answer? Let's walk through it. Okay. Over the next 10 years. So this is a 1-year cash flow analysis on the property. On the left side, you'll see it was bought for 400,000. LVR is 80%, which is pretty typical. Your loan is 320, meaning that your interest, which we'll see here, is 12.8 on your standard interest rate of, I think it was 4%. What we do here is typically what you'll see in your tax return, right? You'll take your rental revenue minus depreciation, all the other stuff. That's what you'll see. But it doesn't take into account the fact that you have to pay tax on it. And we've assumed that you're on the middle tax bracket of about 32.5%. You'll have profit after that. But still, even that's not the amount after tax. you're not actually paying for depreciation. So you add that back. And instead of that or that, your net cash flow after the first year is actually 8.5. Similarly, when you sell the property, you're not going to make a profit of 112,000 after tax. So you apply the 50% discount. Everyone know how that works. If you hold a property for longer than 1 year, yes, 1 year, you are only assessed on half of the capital gain. That's if you hold it personally. You apply tax of 18,205. So at the end of it, you'll sell for 512. You'll pay back the bank 320. That's the actual cash. You'll pay that much in tax. You'll have that much. Okay. If I move on to the next slide, that's typically what it'll look like. You'll put in 80,000 at the start. First year, it'll keep going. Can anyone tell me anything interesting about the cash flows here? Anything you noticed? There's a chocolate on the line. There's always positive, yes. But if you notice, it keeps going up. Okay, and what's the reasoning behind that? Typically, over time, rent goes up. People don't typically factor that in. Okay, they go, the rent is this much, we'll do that. And you miss out on that much analysis. And also, it's always positive. Someone said that. You get 187,000 gain at the end of it. Let's look at the negatively geared property. And I understand there's a lot of numbers here, and I'm being quite boring, but there is a point to this, I promise. Negative gearing. Everyone understand what it is? Okay. For those of us who didn't want to say yes, it's typically where the expenses on a property are more than the revenue, and it means that you can offset that loss against other forms of income. It's been very, very popular in recent times because you'll be making, if you're on a very high income, you can offset it against your current income, pay less tax, and at the end of 10 years, you sell the property and only get assessed on half the capital gain. So it's really good for people who hold on to property. However, the one thing I'll say is never invest in a property just because it's negatively geared. I get a lot of people saying it's like receiving a gift. Oh, it's negatively geared, I have to buy it. Buying a negatively geared property just because it's negatively geared is like getting your tonsils removed just because they give you ice cream afterwards. It's not the smartest thing to do. Look at the property first. So here's a negatively geared property. Don't have to look at everything in too much detail. These are just to make me look smart. At the end of the first year, you lose 3,640. So you're actually paying money to hold this property. It's not quite the most beautiful investment you've ever seen because you're paying it. But the end of everything, remember it was about 187,000 before. At the end, you sell it for 403. So this is what it looks like. You pay your 80,000 at the start, and the first few years, you're actually paying. But then it goes into positives in the last two, and there you get a huge amount. Comparatively, that's what they look like. Looks very pretty, but what I've done is I've added up all the red flows in and all the blue flows, and you can see that through that, the negatively geared property gets you 393,000 over the 10 years, and the positively gives you 281,000. Which one's better? Okay. Anyone understand the concept of the internal rate of return? Okay, so again, just to elaborate, these are the same three amounts, same payments. At the end of it, each investment gets back $130,000, right? The first one, you get 130 after the year 10. Second one, you get paid $3,000 per year for the 10 years, and at the end you get your investment back. And the last one, you get $13,000 per year. Same amount monetarily. Which one's the best one? Which one would you prefer?
Third one.
The third one, right. You see that the only true 3% is that one. This one actually returns you 5%. And that's because you're getting your money back faster. So even though they're all getting paid the same amount of money, so when I apply it, the positively geared one actually gave us the better internal rate of return. And that isn't immediately obvious unless you run all the analysis beforehand. Now, what people are thinking right now is, I can't forecast 10 years into the future. I can't tell you what I'm going to sell 10 years from now. Right? But what I can say is, based upon what we've done, we sold this property here for 786. For it to be as good as the positively geared property, I don't have it on this slide here, it would have to be sold for 840,000. So that's what, another 50,000 on top of this? That allows you to game and say, okay, this is how risky it is. How much more money do we need to make for it to be better than this property? The second part, now you just figured this out, you use this system to, before I start on that, I'm assuming it's the same person in both, and we're not taking into account how old they are or which stage of life they're going to be in. But typically, positively geared properties, better for young people, helps you to build up a bit of cash over time. Negatively geared, if you're older, on a higher income, and you're planning to sell it in the next 2 to 10 years. What we then do is we look at how you're going to improve your cash flow. There's a couple of ways to do that. You can improve the property. You can renovate the property, add a granny flat in the back. For typically the same amount of investment, you add much more cash flow. We take this back, we'd say, okay, we put in 80,000 at the start. What if we put in another 50,000, renovated the property, how much more rent could we get? And then you can judge whether or not it's worth doing this to your property. I highly encourage this for people to do this, because there's often a trap where you buy an investment property and you say, well, we're going to put in a mobile deck at the back, redo the lighting. It's not actually generating that much rent. At the end of the day, we're here for money. We're not here to have something to put on Instagram that this is our new profile photo. Change the use of the property. Childcare has been really popular for the last 10 years. NDIS has come out in the last year or so, I think. I've seen rates of about 14% on rental yield alone. I'm not talking about the analysis we did before, rental yield about NDIS. So consider changing the use of a property that you purchase. Here's the one you guys came for. It's not as big as the other two, but keep good records. The number of people who've come to me saying, yeah, I definitely paid for that. I can't remember how much it was. I've got the receipt somewhere, but it's faded, so I don't know how much that was either. Keep the records. It's actually worth money to you to do that. How many people have an investment property so far? None? Have you got a depreciation schedule done on it? Yep. Anyone who hasn't? Okay, good. Typically in the first year, I've seen you deduct about $10,000. That's just leaving money on the table. I've had a couple of people, I said, listen, you need a depreciation schedule. They say, well, how much does it cost? Anywhere between $350 and $500. Oh, not paying that. Not paying that. But yeah, that's just, what do they call it? Penny wise, pound foolish. You're trying to save a bit of money here, but over the course of it, you'll make that money back many times over. Consider investing interstate. Has anyone invested over the state lines? Yes. Why?
Well, I wasn't looking for capital gain. I was looking for rental returns.
Rental,
Like gain.
right. And you are aware that you get a separate land tax threshold over there? Yeah. So I had a call actually from a doctor the other day. He goes, and I know him quite well. It's not like he picked me out of the phone book. He said, I've got a patient here and he's been hit with a $53,000 land tax bill. He's having heart palpitations. Can you please give him something to calm him down? And I said, I'm afraid, look, he's going to have to come in, but that's how bad it can be. If you don't plan your investments, he bought all his properties in New South Wales and didn't take into account the fact that he's going to lose a lot of that threshold. And picking the right structure, which is a lot of what I'll be talking about at the end of this presentation. The biggest mistakes I see, and I see a lot of investors, unlike Cube Corp, I'm not in the business of selling property, so I'm seeing it buying it from multiple people. People, they don't get the proper advice at the start. They typically go with a mortgage broker that their friend has recommended to them or who has met them at the gym. They buy the wrong property. They don't do this analysis. I highly encourage you. And I've actually spoken to Don about some of his. They're amazing properties. I can vouch for them. The returns he's been showing me look really good. And they picked the wrong investment structure. And that's the one a lot of people don't get advice on. And I'll explain to you towards the end of it why that doesn't happen. Second part, not getting the depreciation schedule. Luckily, we don't have that problem in the room. Not sticking to the plan. Again, pumping a lot of money into the property after you've bought it because you're so excited that you decide to blow everything on it. Now, the second part is what I'd like to talk about in terms of asset protection. And people say, well, what do we need protection from? Excessive taxation. Like I said, the ATO love cracking down on people. I think this year they're going after people who have Airbnb properties and guys who claim more than $150 in their laundry. Big dollars. The truth is the Australian government has spent a lot of money over the course of the last year in terms of COVID, and they're going to need to make that money back over the next 20 to 50 years, and you guys are going to be the ones paying for it. So it's ideal to sort of prepare yourself now before you buy the property, because the last thing you want is to have to transfer property around to get outside tax. Second part, frivolous creditor claims. Hopefully everyone here is going to make some really good financial decisions and make a lot of money over the next few years. Typically what you find is once someone starts making money, all of a sudden people start wanting to sue them. I know this for a fact because I used to work for a liquidator, and the first thing we do before we take someone to court, see if they own any property. And if they own property, they're more likely to settle out of court because they've got more to lose. And the last one is commercial disputes. So if you go really well in property investments, you might start doing property development. And the number of people, do we have any lawyers in the room? No, none. The number of times that I've been with a lawyer and he says, oh, we've just got another dispute where the builder and the developer are in a dispute and the owner's in there and everyone's losing money. If you don't organize your stuff, you can actually lose all your property to that, to legal fees and claims and all those kinds of things. So these are typically the three things that you need to think about when protecting yourself. So, shouldn't have signed that one. All right, these are the 5 basic structures that people talk about. We've got the sole owner, joint owner, company ownership, discretionary trust, and the self-managed super fund. I'll go through each of them very quickly. Sole owner. You're all sole owners right now. Regardless of what you've done, you're all sole owners. It's the easiest one to set up because you don't need to do anything. You're also able to claim the main residence exemption. So if you're just starting out, you can move into it, and then you are exempt under Section 118 of paying any capital gains on it. Cons, like I said, it offers the least amount of protection. If someone takes you to court or the tax office wants it, they take it. It doesn't allow you a lot of tax planning. Second one, it's easier to get finance under where you've got a husband and a wife, you've got 2 incomes to service the debt, and you also get the main resident exemption. The cons are, again, very little protection, and what a lot of people don't realize is when they buy a property with their husband or wife, they lose the additional land tax threshold. So the first property, they go, all right, we'll go halves in it. You know, husband, wife, it's all exciting. But then you get, doesn't anyone know what the land tax threshold is in New South Wales? About 750, close. You know what, here's another one. This one's here. That's behind. Okay. The next one I'd like to speak about is company ownership. This one gets recommended a lot. I don't know why. Typically by people who come to me saying, can you please fix what my previous accountant has done? And I think the reason they pick company ownership is because they think you get some kind of protection. The fact of the matter is it doesn't offer a lot of protection to you because if people are suing you personally, they can take your assets and the company is an asset of yours. There's no separation between you and the company from a legal sense. But what it is good for is you get a flat tax rate of 27.5%. And what that means is if you've got huge amounts of money and you're buying lots of properties, you can use the company structure to develop and deduct business expenses. So you can end up putting motor vehicle expenses and I didn't recommend this, but some people have put vacation expenses under their property development company and it's completely tax deductible. That's stuff you can't normally deduct if you've got a rental property.
What about the GST on the company? There's not, is there?
No, there is definitely GST. That's another thing you need to take into account.
As well.
Well, if your turnover is more than 75%, 75,000.
So you pay capital company tax and GST yourself?
Absolutely. Absolutely. First sale. Residential property, I think on the second one there isn't. Here's the one that, the second most common one that I get asked about. Anyone heard about a family trust? Anyone have one? Yeah. You have the property in it? Okay, smart. Okay. So I got a call today from a very, very wealthy business coach and a CEO, and he says, the only thing I know about this stuff, because I told him I was going to give a seminar today, is he says, you put everything in your trust. And I said, why? He goes, that's just what everyone does. The reason why I wouldn't use a trust initially is it doesn't give you a land tax threshold. So on $750,000 of unimproved capital value, say you've only got $500,000, a property that's worth $500,000. You typically wouldn't pay any land tax on it if you buy it yourself personally. However, if you buy it in trust, you don't get the threshold, meaning you pay another $8,000 per year in land tax that you don't really have to. Now, granted, give you a high level of protection, but there's ways to get around that to give you some protection, which I'll talk about in the next few slides. Last one is SMSF, Self-Managed Superannuation Fund. Sorry? Okay, right. These ones are really popular with the older generation about to retire. 15% flat rate, meaning no matter how much money that fund makes, that property makes, you only get taxed on 15%. If you're a really wealthy individual, you're getting taxed on close to 50%. Big difference. On $100,000, that's a $35,000 difference per year. Con of that is you can't really access it until you hit preservation age or retirement. What we do is we do hybrid arrangements. So all those five things that we talked about before, you mix and match them. You get the best of both worlds. This is the typical arrangement in a property development company. They have the assets in one branch, they have the trading company that deals with customers, and they have the employees in the third thing. Does anyone know why you keep them separate? No? No suggestions? Was that? No, that's a camera. Okay. So the reason why they typically do it this way is you put the employees in one because it's separate from the trading and asset companies. And the asset will typically hold your bulldozers, all your equipment, things that actually hold value that would be sold if it was to be liquidated. The trading company deals with customers. So if you've got a legal dispute with customers and they take you to court and say you have to end up in a creditor's voluntary liquidation, CVL, it doesn't affect your assets. They can't access the assets. It's just a trading entity with a bit of cash and maybe the capital limit. The employees are held in a separate one because if they make claims against the company, they can't access the trading or asset companies. So if this gets closed down, you don't actually have to put in liquidation when you're doing business with your customers. People do this because it means that you can shut whatever property down, what company down, to keep going. Underneath, you have what's known as special purpose vehicles, SPIVs. If you look at the large apartment buildings across Sydney, each apartment building would be built in a separate company. And the reasoning behind that is like what I spoke about. If something goes bad with SPV3, you just liquidate it. It doesn't affect the other 5 entities in the group. Unfortunately, this has been used to the detriment of a lot of people because what builders will do is they'll set the business up here, move the assets over to SPV2, and get sued in this one and nothing happens to them. So it is actually a very powerful strategy, but use it for good and not for evil. This is a business. This is something we typically deal with property investors such as yourself. Like I said, you can hold it in your own name and it's not quite safe because it's in your name. However, picture this as a house. I know it's a very rudimentary diagram, but you have your debt on the house. Say you bought it for $500,000, you've got $400,000 in debt. Your equity would be about $100,000. In the event that you get taken to court and that thing gets sold, the person who's won the court case gets that $100,000 in equity. What we tend to do is we have a trust, and in the trust we have an agreement with yourself that in the event that you are forced to sell that property, that equity goes straight to the trust. Meaning, yes, it's in your name legally, but equitably, that's in the trust. So it's not as safe as holding it in the trust itself, but you get the benefit of not having to pay that much more land tax, but also another level of protection in case something happens to you. Of course, the bank always gets its share. So here's a very quick case study. This is an actual husband and wife who we've dealt with. This happened last month, I think. And this is what they came to me with. They're a husband and wife. They run a small business. They have a duplex investment up, I think, on the New South Wales North Coast. 1 million, they expect to sell one of the units in 14 months, and they're going to lease the other one out, just positive cash flow over the next, now till forever. Their previous advisor, like I said, they always advise family trust. What we did with this is you run it through each of the models. You go, all right, what if you held it jointly? SOL, SMSF. What if you did it all in each way? And how much money are you left with at the end of the first year? And surprisingly, the trust came out at the bottom. Trust came out with only $283,000. We recommended that one, even though it's the simplest one. The difference between that and that was about $50,000 in 1 year, just by doing this exercise. And this is not even projections. This was just 1 year. This is how much we're planning to sell it for. That's what market rate is now. They saved $50,000. The great thing about that is, in addition to that, they saved another $11,000 per year on the other property going forward. So for a very quick exercise, it only took them about a week to work with us to get that done. They saved $55,000 in the first year and $11,000 for every year after that. Now, typically this is the part where you'll see a slide that says questions, and I stare at the crowd and no one really asks me any questions. But what happens is usually I'll be in the bathroom afterwards and someone quietly asks me something because they didn't want to say it in front of the crowd. So let's go through those ones. First one, is this all legal? And I know it's an understandable thing because I'm saying you can be protected from lawsuits, minimize your taxes. Absolutely, this is legal. One of the numbers I love pushing out is in Australia, about 50% of members of parliament are beneficiaries or have interest in a trust. Only 5% of the general population do. So that's 10 times as many of people who actually make the laws have interest in a trust as people who actually, like you and me. What I will say about this though is if you visit enough property sites, you'll start getting ads by certain characters that say that we can bulletproof you and you never need to pay tax again in your life and we can do all this guaranteed. I probably wouldn't say that's quite legal, and I've done my research on these people. I think you've seen these ads. One of them may have lost their license to practice recently. We will tell you what the risks are. We get ourselves and a lawyer to grow up a written advice saying this is what it'll protect you from, this is what you're not protected from, this is the extent to which you will save money, this is what's expected. So it's not a matter of just waving a wand and saying, you're absolved of all debts and tax debts. Second part is, then why doesn't everyone do it? If it's so good, you're saying that this is, the best thing since sliced bread, why doesn't everyone do it? The answer is, how many people have been given this advice before they walked in the room? Not many, right? That's the reason. You wouldn't go to your corner store accountant or lawyer to set something like this up. We've spent a few years. I've got a background in commercial law and accounting. I deal very closely with two law firms that deal specifically with tax. And it's a very sort of specialized area. What I can say is in the more wealthy circles, this is very common. I think every surgeon that I've ever met has got this set up. Every law firm partner, big architectural firm partners, they typically have these things set up because it works. So while it may cost a little bit when you're setting up, people always say, where can I get the cheapest conveyancer? I'd like to save $100 on this, $50 on that. They don't usually want to spend another couple of grand getting something built to save them down the line. So what I can say is on the biggest side of town, the wealthier side of town, this is actually very common. And this is what I'm trying to recommend to everyone, my family included. Lastly, how much does it cost? Well, like I said, everyone's a sole owner right at this point. You don't need to do anything. What I do recommend is you get a tax assessment, so the exercise I showed before, where we show you how much you would be paying under each strategy. Typically, that will cost you about $1,000. It will sit with you and walk you through all the variables and how much you expect to make. And I've never had a client where it hasn't paid off for them. I can say that much, where we haven't showed them, listen, if you do this, this, and this, you'll make much more than the fee was. Thank you for that, guys. I know it's been really exciting, but if you've got any questions, I'll be hanging around afterwards.
He'll be hanging around here, not the bathroom. So you can ask him here. So guys, we're here for investment, and as Salman Khan said, the people that really make the big bucks and that continue to do so, these inner circles, make those little investments early on to make the profit later, okay? And when we're dealing with property investment, it's not a short-term gain. We get too many people, particularly first-time investors, and I know there's a lot of agents that are here today that have said, they've come up to me and they said, I've got a client and they want something that they can sell in about a year's time. I was like, why? Or even less, okay? So property investment is not a short-term gain. It is definitely a long-term investment. So that's what my part of this presentation this evening is about. And let's look at the market that we're talking about. The big three. Because I know all of you here, if you weren't invited by an agent, would be looking to invest either with CubeCorp or through your own sources, and you'd be asking yourselves some questions. In Australia, right now, there's about 25,781,000 Australians. Now, about 83.4% of those people only purchase once in their lifetime. Out of that percentage, only 5.5%. I'm not going to go through all of these. Look, you can all see there's only a small portion of the population. If we sum this up, it's less than 7%. Oh no, sorry, 17%. Okay, that own multiple investment properties or even get involved in the investment property game. Who's a first-time investor? Hands up. Awesome. Don't be ashamed. We're here to learn. I know you're not. But that's all right. Thank you for participating. I want to own more than 6 properties in the next 10 years. We all have individual goals, and each and every person's individual circumstances are different. But at some point or rather, who wants to own 3 properties? Who wants to own 5 properties? Wow, still nobody. What about 6 or more? Okay, that's about, those 6 or more properties, I'm not talking about in a long, like throughout your whole life. There are some people with the right strategies that can accumulate this sort of structured pattern in purchasing and investment every 2-3 years, purchasing 1 or 2, and in a matter of 10 years, yes, as Mr. Khan said, that there are some people that are spruiking some, I guess, legally misleading information. But it can be done, and if it's done the right way, with the right information. So, what's the big secret, Mr. Dunn? No, I'm kidding. I only say that because when I first started, I come from an engineering background, and previously to this joining Cube Corp, I was a part of a civil furniture, a furniture company, so I was an engineer there. Okay. Before that, I was with the Air Force. I had only purchased my first property sub 28. Okay. When we went to look at some investment options with Mr. Don, I considered one. And then he said, okay, pick me 15 or 16. I said, oh, okay, maybe this is for the sales team to sell. And he goes, Susan, is this enough? He goes, yeah. Who's Susan? Susan's the CFO. He goes, yeah, that's enough. This was for himself. And I thought, wow, what's the big secret? Why is it typically all these Chinese guys purchasing so much and no one else? Like, is there some secret to it? And not to be racist, I'm not Chinese, my wife's Chinese. But why is it typically these groups of people that are making massive influences in the property investment market? Okay, so we might share some of those techniques this evening. We went through some property fundamentals earlier with Mr. Salman Khan, and you're all knowledgeable. The key 3 things that when you're looking to get out of a property is capital gains, which only happens when you actually sell off the property and make some form of increase. The second is from cash flow. What sort of rental return am I going to get? Physically, am I paying for this property or am I getting money from it every week? And of course, the third point is about tax benefits, okay? And Mr. Khan went through that earlier. My tips are know your goals, know what, where, when, and why you're actually doing this. Just because your auntie purchased in a certain area and a certain property does not necessarily mean it matches your particular situation as well. We often get asked the question, should I purchase here? Should I buy that? Which is better? I was walking here with a few of the directors and the executives from the company. We always get asked this question, apartments or houses? Particularly for the older generation, there is a massive divide. I blame a lot of the social media and mass media that's created a lot of hysteria around this. Okay. But really the answer, and we all tried to give an answer, and Don said to us, no, you're forgetting the fundamentals. It's based on the individual. Okay. Every single circumstance is different, so you've got to know why you are getting involved in this. Some people say the simple reason is, because I want to make extra cash. But guys, everyone's situation is a little bit different. So, know your structure and know your plan. And of course, equip yourself with a qualified team. These are brokers, these are the right lawyers, these are the right solicitors, conveyancers, and I said brokers already, hey. Financial planners and accountants as well. Okay? Sorry? What was that? Okay. So, agents here, what's the number one question we always get asked by a client? When is the best time to buy? Exactly. And I'm sure you're all thinking that. Do we have any answers? Okay. Yesterday, that's right. The second best time is when you're ready to go. I'd say right now, but if you didn't have enough deposit, I'll be misleading you. Okay? So, it's rather, instead of asking when is the best time to buy, the question is, where is the best time to buy? Understanding property investment is understanding cycles. Now, we're all Sydney-siders, but the reality is property cycles interstate everywhere throughout Australia, and even if we expand that vision, even globally, everywhere has a particular property cycle. Are you guys aware of what I'm talking about when I say property cycle? When you're purchasing at its lowest, then it makes a bit of a correction, goes through a bit of a steep increase, then corrects itself, and then a little bit of a drop. We're always trying to buy at the drop, right? When do we know that we've hit the bottom? Okay? When it's already started to go up. Okay? Now, why do people continue to want to invest in this country, Australia? Because it's one of the most predictable economies throughout the world. Okay? Outside, pre-COVID, even during COVID, it's still attracting the largest numbers for people intending to invest, regardless of legal change. And Australia's still up there in terms of the top 3 over the last 15 decades, okay, for immigration and for investment. So, in Australia, where's the best place to invest? Come on, guys. Give me something to work with. All right. What about Northern Territory? Who likes sand? No, we don't like sand. Okay. What about South Australia? There's a lot of good wineries there. What about if you're doing commercial investment? Oh, different question. Okay. But no, we're not going to talk about South Australia. Western Australia. How about that? If you're a Chinese conglomerate trying to buy something over there, get into it. But no, we're not going to be talking about that tonight. How about Queensland? I think you guys get the gist. We're blues, right? We're left with the two. Sorry, sir. No, I'm not that sorry. Queensland, maybe 15 years ago, but it's getting there. It's been getting there for about 30 years, okay? We've got New South Wales, we've got Victoria. Victoria's also got a lot of COVID, so we're not going to talk about that either. So we're stuck here in New South Wales. You're all Sydney-siders. I've also got a little bit of extra circle there, but let's look at why New South Wales, Sydney continues to outperform the rest. Now, Dr. Andrew Wilson, who couldn't make it with us tonight, I don't know why he couldn't make it tonight. Anyway, he couldn't make it tonight. For years, he's been in the media and has come up with the pretense that Sydney will never be outperformed by anyone else in Australia. And why is that? The continuous infrastructure, the global demand, and what's here right now is the reason. It continues to be one of the highest demands globally. Outside of Sydney, in terms of immigration, we're looking at 3 other countries. What are they? New Zealand, who likes lamb? Okay. Canada, pancakes. And, what was the other one? I think it was like the Greek islands, but you can almost buy the whole country with one of these Western Sydney properties. Anyway, it's consistent and it's predictable. When we're doing cash flows, when we're doing sort of analysis, globally for the last for over 50 years, we've found that I haven't found, but the research has been done that it's been consistently between 5 to 7% as capital growth. Okay, this year, actually, let's dial back a little bit. Think COVID. There was a lot of people at the start of early last year predicting what sort of drops in the market. 20 to 30%. Were they right? Absolutely wrong. Those same people later in the year did the same articles saying, no, it actually increased 20, 30%. In fact, Epping, the number 1 performer from the 2020 statistics for Sydney, performed 33.96% in growth. Third came Cogra, okay, which I'll be talking a little bit about later. So I'm not sure if you can see the statistics, but you can see this increasing jaggedy line where we've got the average property price of $870,000. It doesn't appear to be going down anytime soon. Would anyone care to challenge that? Of course not. That's core logic, that's not me. Sydney statistics, they continue to go up. just the last 3 months, these are statistics taken from the 16th, so just yesterday. And we can see that rental yields, even though they did take a turn, everywhere else did. But still, Sydney still performs relatively high compared to other markets. So we're seeing that dwellings are increasing value on about 9.3%. And just down the bottom, you can see this was actually predicted by ANZ Bank, a fairly conservative prediction of approximately 19% growth. The only other thing that came close was for Melbourne properties. But those have steadily gone to a prediction of closer to 10 to 12%, 7% difference. Okay, so enough talking about that. Where are big three I'm talking about? I'm not going to give individual suburbs. No, I will. You're here for that, so I'll give you a few. But this is unbiased information, not just the properties that we're selling. This is about what is happening. And these are the big three regions that are outperforming and super high demand right now. The South Sydney region, the Sydney Northwest, and the Sydney Southwest region. So, let's start with South Sydney. On the side here, if you take away any of those $1 million properties, the top front runner there for median property prices with growth exceeding 20% over the last 3 months is Kogarah. So even though in South Sydney there's quite a few councils and regions that we're talking about, I'd like to specifically focus around Georges River City Council. Why? Because out of the 44 different councils that are in that region, this is the one suburb that has experienced the highest amount of developmental approvals over the last 18 months. What the heck is a developmental approval? Well, love it, trust it, or hate me, or don't believe me, but the reality is Sydney, Australia as a whole, is in an undersupply. We may experience some local oversupplies, but that, apart from what the news is saying, our statistics and from what we've seen in the market, we are currently at an undersupply. These areas, as an investor, it's important to understand that you've got to look at areas where they are putting more money and the government is injecting more money into these approvals to get more properties built there. Why would they build them there? Because demand is high in these areas. Now I'm going to focus on two of the suburbs within the Georges River City Council, Hurstville and Kogarah. I left out Rockdale because, well, I didn't want to just put one there by itself. That's in Bayside Council. Okay. So, Hurstville. What do we know Hurstville for? Chinese food. Yum cha. Okay? An interesting ethnic community. It's a melting pot. But guess what, guys? This area is a part of Georges River Council, which is an $80.7 billion economic zone. Did you know that? Steve knows that because we did a suburb profile about it. It's got a Westfield, it's got lots of apartments going up, it's got houses, and it's got a lot of schooling in that area. What else does it have? Properties with this sort of cash flow. And this is the sort of thing I'm sure you've come here tonight. If you could invest in an option at $545,000, a one-bedroom apartment, and might you think, oh, this area, a one-bedroom, why would I buy a one-bedroom apartment? It is, one-bedroom apartments actually have a lower vacancy rate than two-bedroom apartments in Hurstville right now. Okay, so this is something to consider. These are conservative numbers that we've put together for an example property for an off-the-plan one-bedroom house. $16.78 per week. This is what appears to be a grossly positively geared property. I've not put into their depreciation, so I'll leave that to the tax experts. But who would be all right if their coffee was paid for a few days? Yeah? Not that exciting for you. But guess what, guys? The growth in the past 8 months for these particular properties is over $17,200. So, people purchasing properties right now, once this is done, this is exceeding the market value right now because they are purchasing what we call below market value properties. This is one of the insights when you're looking at properties, key ones to look at are off-market and below-market opportunities. Why would you purchase, well, it might be the Asian in me, but why would you pay full price for something? Okay, Kogarah. A lot of people know this area because it is a pivotal station. Actually, geographically, it's awesome because you're between Walleye Creek and Hurstville, but it doesn't smell like yum cha when you go outside. Okay, smack bang in the middle, and actually this particular region is the highest in terms of developmental approvals, just in all of Sydney. Okay, right now there's about 4 blocks that have been rezoned, okay, to support the not just to support the infrastructure going in, but also to support the demand of population wanting to move into Kogarah and surrounding suburbs. What's there? You've got St George Hospital, private, public. It services quite the majority of the Sydney South region. You've got a lot of schools there. Westpac branch is also, is that Westpac or St George? St George, sorry. St George is also got headquarters down that way. There's quite a lot happening in Kogarah, okay? Whether you're looking at something that's ready to go, something that is ready in a year's time or 2 years' time, it has consistent supply. What else is coming into Kogarah? The entrance to a new highway that's meant to take about 10 minutes to get to the city, okay? But let's have a look at what sort of cash flows we can expect from properties in this area. Where we found that 1-bedrooms performed extremely well in Hurstville, 2-bedroom apartments are the ideal investment in Kogarah right now. It's quite interesting because there are some really low priced apartments in Kogarah. But 2 bedrooms for investment still are the front runner for sales. Here we can see that instead of $16, you're expecting about $93 per week gross. Again, not taking into account depreciation. But look at that, 18,000 growth. That shouldn't say 8 months, that should say 3 months. Why? Because we are doing what we call pre-sales, and we've seen the off-market opportunities. I want to ask a question. This is a little bit off topic, but no, it's not. When is the best time to purchase? The time frame of a property. It's at the start or right at the end. I always tell this to my clients. Why is that? At the start, the developer, the vendor, the person trying to sell the property needs money. This is the best time to bargain. They're going to throw every single incentive to try and get people to get funds. They also need to get loans as well, okay? And right at the end, because they're trying to, sell all their properties off, then they've got a chance to negotiate. So right at the start and right at the end. Where I'm getting with that is we've seen that properties that we were previously selling and are still selling now. Andrew is currently one of the kings of Kogarah, selling properties every week. He's noticing that these properties are still selling even though they've increased by prices greater than 18,000. Why would they do that? Let's move to the Sydney Northwest region. This is typically known as the areas for Marsden Park, Rouse Hill, Schofields, Riverstone, Box Hill, Kellyville, even places like the Ponds, Colby, up there, up north where it takes you 18 minutes to get KFC. I'm going to ask Mr. Khan to come up to explain this next slide because this is actually a case study, a real-life case study for one particular lot of land. It was a 400 square meter lot. And please welcome the handsome Mr. Khan. Pops up.
Oh, yes. So, what am I doing?
This is what happens when you have too many wines.
The 4 wines, I can do anything. Oh, yes. So basically, we'll talk about this a little more in detail later there's a couple of questions that we'll answer. But I'll talk about the case studies now, and then later we'll have some general questions, like when is the best time to buy? What's the other ones? Yeah. We'll talk about that later. So basically, some people have heard this story already, but at, I think, beginning of February, basically at the moment, I don't even know where to start.
We had some land. It was 1,400 per square meter.
That's right. Basically, at the moment, everyone can pretty much tell that house and land is the king at the moment. And we'll get to that at the moment. I'm not saying that house and land is the only way to go. There are really good apartment options as well. But I'm personally focused in the house and land market. And we've been doing some really crazy numbers just with house and land. So just even little silly examples, I bought a land for 600 and sold it for 700 within 24 hours, right? That was something that's very rare, but achievable in this market. In this particular case was a very good case, I think February 8th or something like that. A Chinese person called me and he had this 400 square meter land in Rouse Hill. Some people have heard this story before. He said to me, if you can sell this land in 5 days at 1,400 a square meter, that means this land is 640,000. I will give you $50,000 for the first day. The second day I'll give you 40, and the fifth day I'll give you 10,000, and the sixth day we have no contract anymore. I said, no problem. I posted it online, and within 3 days I had over 100 calls. And I think Mark was with me playing golf, and I had to quit halfway because in the morning at 9 o'clock it just kept ringing and ringing. It was at this point where I had such a big volume of calls that I didn't even need to take them up to see the land or anything. I just said, this is the address, go see it yourself, tell me if you want it. That's it. Yes. It was, yes. So one particular person said, I saw it with my wife and tomorrow I will go and sign it. What's your trust account details? I said, okay. I texted him my account details. He sounded really nice on the phone, transferred the whole $64,000 to our trust account. I said to him, oh, whereabouts do you live? He lives in the city. He goes, I will meet you at 7 a.m. tomorrow to sign this contract because he has work at 9 o'clock in the morning and he wants to meet me at 7 to leave at 8 to get back to the city by 9. And he lives in the city. This guy is dead serious. So I wake up at 4:30 that next morning and I was super excited. I was like, oh, this is the easiest $25,000 I'll ever make in my life. Okay. All excited, I check the traffic. There's 2 traffic jams. I get there at 7:30, but we're both late, so that's okay. Him and his wife come out of the car. They look super excited. They look at this land, they nod, they like it, they take photos. I don't know if they're FaceTiming their family or whatever. 5 minutes later, he says to me, oh, show me the contract of sale. I printed out this 322-page document. 640,000. He's super excited. He goes, okay, did you get the money? Can you confirm you got the money in the trust account yesterday? I said, yes. We sent you the receipt yesterday already. So 64,000 already received. This is the balance. He goes, okay, before I sign, I will sign right now. By the way, remember, this land is 640,000. I will sign right now if you do it for 550. I woke up at 4:30. I was a little agitated. My response was, I hope you have a good drive back. When we get back, I'll tell the accountant to refund you the money. He's like, no, let me think about it for a day. I said, yeah, you do whatever you want. Okay. I was really tired, all right? And so I couldn't even get back home because it was a 2.5 hour drive home because of all the traffic. So I hung around and I called Mark and I was ranting. I was like, oh my gosh. But anyway, what happened that same night at like 11 o'clock, this original purchaser gave me a call and said the contract is cancelled. And I was a little annoyed because I said I had 2 days left. I can still make the sale. It's not that hard to make. But he knew something that we all didn't know anyway. But what happened was the news the next day was very interesting. Little background story is they tried to negotiate 550 because 50 meters or 100 meters away from this land, there were like 4 trees. So the wife goes, it should be 550 because it's bushfire prone. I was like, there are 4 trees, 50 meters away. It's like, yeah, but bushfire. I'm like, yeah, but no. So I let it go. I was happy to wait for it tomorrow anyway, but we got the contract cancelled and of course my heart broke a little bit. But what happened overnight, of course there was a lot of background things overnight that happened and I wasn't sure what it was. But the paperwork was already in the council and the council had already approved it. So the next morning when I woke up, that where those 4 trees were was going to be a big road, Westfield was building, and 37 other retail shops were building. That land went from 640 to 980 overnight. Right, overnight. That's why he cancelled on me, which was a little sad. But now that land is worth 1.2 and still going. So now you can get a single story 111 square meter house on it for $1.5 million. Would you buy it? Yes, I thought so. Yes. So there's a lot more examples of, there's a lot of crazy stuff in this market, but we'll talk about the market a little more, especially in, everyone's talking about the new airport in Austral, in Leppington, in all those areas. Yeah, we'll talk about that later. Okay.
So long story short, 640 to 980, I put 3 months. It was actually 3 weeks, that increase. And that's all to do with the background knowledge of knowing what is going on in that area. Okay, and let me give you another case. Marsden Park. Everyone knows this place, but if you're investing or looking around the Northwest as one of the most populous areas at the moment, well, actually it's because Schofields, Kellyville, and Rouse Hill are just crazy expensive right now. So they went to, Marsden Park is the next pick. Marsden Park right now, they were looking at this sort of dual key property. This is one of the available properties with one of our partners, Brolin Homes. And you can see here that purchasing this as an investment property, this has got a 1-bedroom studio plus a 4-bedroom house, single story and double garage. It costs about $900,300, okay? And you're expecting a gross yield of about $338 per week. Not bad. That's some rent for some people, okay? But that's a fantastic property. But look at this, land price value. So what was one of the types of properties I was talking about where you can get a really good deal? Well, that's when it's below market. I'm going to show you an example right now of an option that is extremely below market. This land size here is 270 square meters. Tiny. It gets smaller. But guess what? For the same land size right now, and they're actually selling this for about 610 and 580. Okay, that's being advertised right now. There's land right now for the same size available at $397,000. We are currently working exclusively with a supplier. Now this is an interesting number. Why? Because it's trying to target first home buyers. Because we're feeling that right now, the first home buyer market after April actually started to take a dip. And why is that? Because the incentives for first home buyers started to drop. So to capture that market, you're looking at land value that is over $140,000 below market value. We've had this for about 2 weeks, and almost overnight, we secured 14 lots. Each of these people are what? First home buyers or investors? 12 of the 14 are investors. Why? Because they see that the value in this property, once they settle and it's due for registration at the end of the year, even if it's pushed out, compared to what's selling right now, just the land value alone, they can make up to $150,000 plus. Is that worthwhile? Of course, but I wouldn't sell it in a year's time because of that great cash flow. Where do you get good cash flow in Sydney? The majority of types of properties, as Mr. Khan was saying, in Sydney are actually negatively geared properties. Okay, taking into consideration depreciation, that might also be the case for some of the packages that we offer. But is that quite good? Who would like to make $150,000 on top of their house profit? Exactly. Very good. Okay. 372. Now when we were talking about the Sydney Southwest, Mr. Khan was alluding to it earlier, we were talking about infrastructure. Now the biggest infrastructure that's being put into Sydney right now is the Western Sydney International Airport, where over $88.2 billion are being put just into that investment, just into that set of infrastructure. That's the airport. There's more going on around it. The M12 is getting put in, the roads are being expanded. There's a lot of rezoning, particularly in all of this blue region, this blue area. Once upon a time, people said to me, oh, Campbelltown, I wouldn't go there. It's like 80 kilometers away. That's way too far. We're now still selling properties at 110 kilometers away. People are still saying that's too far. Guess what? We're going even further. Places like Menangle Park, 140, 160 k's away, and people are still purchasing. So, some buzz areas that you should consider when looking at properties, definitely Austral. Marsden Park and Austral are the number one sought after regions. So 1, Marsden Park, and 2, Austral. Okay, not sure what's happening there. There's a buzzing. Edmondson Park, also a well-established area, continuing to grow in value. Try and find house and land there right now, very difficult, but there's some great opportunities for townhouses and also for the apartment market. Coming up, we've got 96 apartments coming exclusive in this area. Bardia, Cobbitty, myself getting involved in Cobbitty, seeing massive growth, massive growth. And of course, I was talking about Menangle Park as well. Okay. Getting a little bit concerned. Okay. So, when we talk about the southwest region, I was talking about a lot of the major influence to this price, even though we're experiencing some crazy auction prices and some crazy sales being done in the eastern suburbs, a lot of that is driven by the house and land market in the southwest. Okay, so these are some things that are there, as I mentioned, about the Western Sydney International Airport, due for completion 2026, and their first flight, 2026. There's massive self-sustaining suburbs, Aerotropolis going in and around that area, a new $32 million project in Gregory Hills, which is going to be the new medical precinct in that area to service the whole of the southwest. Okay, so as Mr. Khan was talking about the growth of prices in Rouse Hill, let's look at this particular case for Cobbitty. 980, this is for a 300 square meter lot size, which seems to be what most people are looking for right now. Even if we consider 250, people are still purchasing because there's something called super lots, which is going to come out pretty soon. These are 200 square meters. Yes, yes, awesome. Between December last year to April this year, that's almost a $1,000 increase per square meter. Those of you that can't do maths as quickly as other people in their heads, like myself, that means packages from 580 to 820. This was the early stage at Cobbitty. I believe that was a 4-bedroom, 320 square meter house. Okay? Right now, 280 square meter house. 280 square meter land, 4-bedroom house. Sounds good? Guess what? It keeps getting better and better. So, let's look at the cash flow on this. This type of property is going to set you back this much, about $865. That's the average package that's going out right now. It's not a double story, that's actually a single story house. Okay, add another 50,000, you'd be looking at a double story. Okay, but the key thing to take away from there is that not only are you experiencing massive growth, capital gains or potential capital gains, but that's not bad. $123 in your pocket every week, wouldn't pass that one up. Okay, so does anyone have any questions about these house and land packages so far? No? Great. But wait, there's more. Okay, not everyone is looking at house and land packages these days. Why? Purely because of the affordability, particularly those first-time investors. There's a saying which I'm going to get to at the end, but it's to do with time in the market is far superior to trying to time the market. Okay, the average Sydney cycle is between 7 to 10 years. You've seen how much these land prices are growing by. If you wait to try and predict when is the next bottom, that could cost you hundreds of thousands of dollars. Okay, so time in the market. So, where am I leading with this? You don't have to spend $500,000 or crazy amounts of money like that. Mr. Khan was suggesting earlier, those people who are investing outside of Sydney, who were they? Anyone investing outside of Sydney? Fantastic. Why? Because of the affordability, okay? Even though Sydney is the premium choice and it does have that flexibility, you might get options where you're paying almost half the land price, but you're getting yields over 7%. Is it a real thing? Absolutely. This is a rental guarantee that's happening in Canberra. Canberra? Why would I go to Canberra? Politicians live there. I will invest where money is. The average income for Canberra right now is $94,000. That's pretty high. In some suburbs, like Belconnen, where some of our team have personally purchased, we're not just ones to sell, we're also ones that invest ourselves as well. You're experiencing average incomes of over $111,000. Look at that sort of growth. Yes, you can do a rental guarantee, pay a little bit more in terms of the, I actually kept the property management the same. Your actual property management in Canberra is actually between 6-7%. Okay, so you'll be saving a little bit more. Like I said, these are conservative numbers, but you're paying less than $350,000, okay? And getting this sort of return per week. We haven't even factored into the picture or the equation how much these are actually increasing by, okay? So, are there actually people in Canberra? Absolutely. Let me tell you one of the strategies that Geocon, who supplies over 70% of the new developments coming into Canberra, one of their strategies is they release about 4 apartments per building every week. Only 4. I know that they have hundreds, so don't be tricked saying, oh, there's only a few to buy. That time there will be. But every day, Thursday, Friday, Saturday, Sunday, those 4 days, we've got people lining up. Per apartment, there's about 20 people looking to move in. I didn't believe this until I went to see it. It's a real thing. In fact, we spent almost a month over there every weekend going there. Thank you, thank you, Susan, for paying for our fees. Okay. So look, guys, at the end of the story, guys, we come back to this question, when is the best time to buy? I went back to that. Time in the market outperforms timing the market. There's so many options out there right now, from as low as $280,000 all the way up to as much as you want to spend, okay? You're all going to come out of this with some bit of knowledge today. My advice to that is, if you're in a position, grab it, okay? There's a saying, a cat in a bag is better than a cat in the hand, because if it can run away, okay? Thank you. So, I was going to do a bit of question time, but we've gone over by about 15 minutes. What we'll do now is give you an opportunity to go out and to come to this side to check out some of the flyers and things that are available right now. Those of you that are looking to get into the market, the first thing you should definitely do is check your borrowing capacity. No one wants to go out shopping without understanding how much they can spend. They could be disappointed. Okay, maybe they could spend a little bit more. So there are some in the finance team. Guys, can you put your hands up, please? So definitely have a chat with these guys. Please get in contact with them, get their cards. They will be able to swiftly advise you how much you can comfortably spend based on your situation right now. So, ladies and gentlemen, thank you for coming this evening. I hope it was informative. I hope it was valuable for all of you. Please continue to sign up with our agents. There's going to be more information nights coming throughout the year. Are there any questions? Some of you taking pictures. Last bit. Oh, Steve, was that a question? Oh, sorry. There was some people taking pictures, some people taking notes. If you'd like to get a copy of the PowerPoint, anyone want a copy of the PowerPoint or the slides? Cool. Please get in contact with one of our agents afterwards. We'll be able to send that through to you. All right, my name is Mark. We're from Cube Corp. Thank you for coming this evening.